This is Barry Knapp with Ironsides Macroeconomics. This is the abbreviated version of our weekly audio summary describing our weekly note. This one's for free subscribers, hence it's abbreviated. Was a note that we got a lot of positive feedback on this week. We titled Quadrilemma. We'll explain what that means in a minute. There were 5 sections to it. The first section was titled The Four Fours. The next one was Transitory Goods Disinflation. It should have been called Transitory Goods Deflation. We then had a summary of the labor market. We titled Lower Labor Demand and Supply. We had a section on a potential for a tapering of quantitative tightening. It turned out to be pretty prescient, and we'll come back to that in a second. And then the final section on the equity market ahead of earnings was titled Healthy Broadening Out. S&Ps are up about 8 points right now. Treasuries have not yet begun trading, but the futures are down 3 plus 30 seconds. The dollar's flat, and crude is fairly flat as well. But the reason S&Ps are rallying is related to that section we wrote on potential slowing of quantitative tightening. That to us was one of the 2 interesting pieces of the FOMC minutes last week. They did in the minutes discuss the potential to start tapering quantitative tightening. And on Saturday, former manager of the SOMA portfolio and now president of the Dallas Fed, Lori Logan, gave a speech about tapering QT. I think that headline is what's gotten the market's attention. But if you read the speech, it was all about looser financial conditions. And while she didn't explicitly state what the policy implications of that loosening of financial conditions are, it's very clear that Ms. Logan thinks that they probably shouldn't be cutting rates aggressively, and the market's way ahead of where the Fed is. So I'm not sure she quite grasped the incongruousness of talking about tapering QT and how that in and of itself would loosen financial conditions relative to then talking about loosening of financial conditions. There is a potential offset for all this. And if the Treasury and Fed aren't coordinating their activities, they should be, because when the Treasury gets to the next quarterly refunding announcement, if the Fed is indeed talking about slowing the balance sheet contraction while leaving rates higher, that could cause the curve to inversion to deepen further. If, however, Treasury could potentially offset that by extending duration of their issuance. So anyway, we don't need to review that section of the note, but I think it was an important section. Wasn't available to free subscribers. That was only in our paid subscriber section, and that's why you should be a paid subscriber, or one of the reasons why, at least. So the 4 fours are as follows. This is our idea that in order to get the Fed to cut to 4% in 2024, the level we think they will need to cut to in order to disinvert the curve, and to get the 10-year note yield to stay below 4, and it rallied back above that late last week on the payroll report, you'll need unemployment above 4 and average hourly earnings decidedly below 4. Now, getting to that 4 fours without a growth scare that causes a rethink of the equity market seems to us highly improbable. So, to use the old Pepperidge Farm commercial, which probably dates me, you can't get there from here. So this is at the core of our tactical negative outlook for the first part of the year, which is how last week's trading progressed and how we expect things to progress this week as well. So we then went on to talk about transitory goods deflation. This is a little bit of a preview for this week's CPI report. The only real contributing factor causing inflation to fall relative to the Fed's expectations, not so much market expectations, is goods prices are contracting at a 2.5% 6-month annualized rate. We do not expect that to persist. Super core or non-housing services are running on a 6-month basis over 4, rents running over 5, all items are at 3, and cores at 4. It's going to be a tough road to get anywhere near the Fed's target. And we think we're due for some disappointment, not necessarily this week's report, but it's going to be tougher to get down towards the Fed's target. And so they will need to see deterioration in the labor market to get there. So as far as the payroll report goes, it did exhibit lower labor demand and supply. The churn numbers do imply wage growth will slow over time, and that underlying demand looks weak to us. So we do think we'll get the unemployment rate above 4 and wage growth to slow below 4, but that will likely not be a happy occasion for the equity market as people will begin to worry about the earnings outlook. And then we finished up with some, a brief preview of the earnings outlook. We'll get more into that next week. Revisions have flattened out, but an important tactical point here is that fourth quarter earnings season is not all highly concentrated into a 3-week period where you get 80% of S&P 500 companies reporting in 3 weeks. It's more like 5 weeks. So it tends not to have quite the impact on the market if we get net positive surprise as you would in, say, the April to early May, July to early August, or October to early November reporting season. So that's it for me this week. Happy New Year, everyone. We hope you consider becoming a paid subscriber in the new year. Thank you. Barry Knapp, Ironsides. Have a good week.